Hey guys, and welcome to this session. I'm going to give everybody a moment to join and then we'll jump straight in. If you haven't been to one of these sessions before, this is where we take a look at the Darwin in a little bit more detail. We go through things such as exposure, value at risk, how your risk multiplier and value at risk kind of work together to produce your Darwin's return. So give everybody a moment to join. If somebody in the Discord could confirm that you can hear and see my screen, that would be hugely appreciated. And then we'll get ready to begin. Right, looks like audio and visual is all okay. So welcome guys. Like I say, if you've not been to one of these sessions before, this is where we take a look at more of the in-depth, intricate details of trading at Darwinex Zero. My name's Kieran and I'm head of UK growth and business development for both Darwinex and Darwinex Zero. And if you haven't heard about us before, we are a regulated broker and asset manager, and we also have a hedge fund license. We're regulated by the FCA in the UK, by the CNMV in Spain, and also by the FSA in the Seychelles. Currently have over 100 million US dollars invested in our platform by third-party capital, and we have over 10,000 active strategies. Now, our main job as a business is to give traders the opportunity to scale. What we have to do is bring capital to our business. How are we doing, FX Bitfinder? It has been a minute. Hope you've been well. Our job is to bring traders as much capital as we can possibly do so, and then find the best traders to pair with that capital. Now, if you're new around here, then maybe it might be a wise choice to go and watch one of our welcome sessions, just so that you understand some of the terminology that we talk about in this session. I run those sessions every Tuesday. They're only about 20 to 25 minutes long, each one, and we have a full list of them on YouTube. So feel free to go and watch those if you're still very, very new. However, your account with Darwinex Zero, your account gets called a Darwin, which is basically a risk-adjusted version of your trading strategy. Now, we take on the risk adjustment, you take on the trading. It's as simple as that. Now, you might think, what is the point of having a Darwin? So number one, it's risk adjusted. Not everybody appreciates this as much as they should. However, seeing what your exposure is like from an unbiased perspective really helps you understand your trading strategy in much more detail, and therefore yourself as a trader, which would benefit everybody. It also allows you to operate under Darwinex's regulatory compliance. So if you want to manage capital, which I'm pretty sure everybody in the stream will be aware of, but if you want to manage capital on behalf of investors, you have to be regulated. Of course, the level of regulation depends where you are globally. So, for example, here in the UK, the FCA are super strict and you cannot touch investor funds. Now, because we're risk adjusting your system and we're monitoring the exposure on behalf of the investor, which we'll get into in a little bit more detail shortly, you come under our regulatory umbrella license, which therefore means you don't touch the capital. So even if you have $1 million worth of investor capital sat in your Darwin, doesn't mean you touch it, but you manage it from a trading perspective. All of your trades get copied to your Darwin, which is basically like an index of your system, and then we manage the risk. The investor will never see your trades from a MetaTrader perspective. They will just see the P&L from your Darwin. If you're unaware, regulatory compliance costs a lot of money. It's really difficult to get it, and you have to pass assessments and put money up front, and it's just really difficult. So being able to partner with Darwinex, for 38 euros a month for the subscription cost of having a Zero account, it bypasses the whole regulatory drama that you would go through normally. And last but not least, you get a proven track record. As I mentioned at the beginning, Darwinex is a FCA regulated broker. That means if you're ever applying for a job at a hedge fund or a prop desk and you need to take your broker statements, they know there's no fugazi. They know that there's no amendments or trade modifications from Darwinex's end because we are regulated, and it wouldn't be worth our license to, fudge somebody's track record. So our track records and our broker statements hold their weight in gold if you're going out and applying for a role. Or even if you just want to prove your profitability on Twitter, for example, if you have a troll calling you out. So having mentioned the risk adjustment, it is highly unlikely that your MetaTrader statistics, that being MT4 and MT5, it's highly unlikely that that is going to see the same return and the same drawdown statistics that your Darwinex Zero or your Darwin account is going to see. Because we are risk adjusting every trade, that means that If we're risk adjusting you down slightly, then you might have made 10% on your Signal account, but you might have only made 8% or 7% on your Darwin. Conversely, you might have gone into 20% drawdown on your Signal account, but you might have only gone into 10% drawdown on your Darwin because we've lowered your risk. It doesn't always mean that we're lowering your risk. There are certain traders, myself included. I run a portfolio of automated strategies, and my risk is so low that I'm being increased by 4.2 times, which basically means for every one lot that I would trade on my account or on my MetaTrader, my Darwin would take 4.2 lots. So there is two sides of the coin. It's not just that we're lowering risk, it's that we're taking a mathematical approach to measure your risk, comparing that to the benchmark that we operate at, and then risk adjusting to get your strategy to that benchmark. So as I mentioned, our risk engine adjusts all of the traders' trade sizes to maintain a value at risk, or VAR/VAR. There's a few different ways that you might hear us talk about it, of around 6.5% per month across the board. Now, we operate at a global stage, right? So we have traders in every country around the world that we accept traders from. It would be very, very difficult to act like a hedge fund or a prop desk or an investment bank where you would have a physical risk manager sat on the desk with you. You might have a head of desk, which is a senior trader looking over all the junior traders, ensuring that everybody is following their plan, everybody is staying in accordance with risk protocols of the firm. We just are unable to do that because our traders are A, trading from home, B, trading as a side hustle from work, and they're all scattered across the globe. It would be too expensive for us to get everybody a singular risk manager. So we built a proprietary risk engine, which is owned by Darwinex, that does this all automatically for you. Now, because it doesn't have that human element, like I say, it runs on mathematical equations. So it will watch your behavior, it will learn your behavior, and it will benchmark you against the 6.5% that you can see on the screen. Which, if you're asking yourself what value at risk means, is it estimates how much money you could lose on an investment over a specific period of time under normal market conditions within a certain level of confidence. So essentially what we're saying is that, I know this kind of sounds a bit wordy, so we do have an example to go over in a moment. But what we're saying is that we're adjusting your value at risk so that we know what the maximum downside is within a certain level of confidence. So that when we onboard an investor, or when an investor invests into your strategy, that investor comes in knowing full well what their maximum downside looks like within a certain level of confidence. Of course, this is trading, this is the market. There is an unlimited amount of things that could go wrong when it comes to black swan events or market volatility. So everything has to be done within a degree of, or high degree of confidence. So we can never say for sure 100%. Let me recap this statement again. So value at risk estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. Now, to make you or help you understand that a little bit better, an example is if a trader has a value at risk of $1,000 or 6.5% in this case, with a 95% confidence level over one given month, it means that there's a 95% chance that that trader won't lose more than $1,000 or 6.5% in any single month. That's not to say that the trader isn't going to keep losing every month, but it's to say that we know the possibility of the worst downside that this trader is going to see within a certain level of confidence. Now, by us doing this to every single trader, it creates a level playing field, ensuring that every trader that trades with Darwinex and Darwinex Zero is judged based on their skill and not just the amount of risk that they're willing to take. Hey Crosby, I can see your message. Hey, I've sent you a DM. Please review and advise. Thank you. I will send you a message after this session. I do apologize. My day has been absolutely stacked today. So usually I would have replied sooner, but I'll ping you a message afterwards. Now, 6.5% sounds like a random number, right? And you might be wondering, why do we use 6.5%? And the reason that we do is because 6.5% value at risk is roughly the S&P 500's risk level. We know that investors are familiar with this risk level, and we know that they're proven to tolerate it over an extended period of time, even through, stagnation or drawdown periods. So what we're doing is we're adjusting your strategy to a risk level that ensures it meets an investor's expectation and risk tolerance. The last thing that we want to do is bring an investor to you. They deposit capital, they pay a fee. Then after 1 month, you lose too much money. The investor pulls their funds. They lose money. You basically yo-yo with your investment, and we don't make any money as a business. That's not what we want to do at all. Hence why we risk adjust every single trader. And also going back to my point that we don't have a trading floor with every 10,000 traders on that we have, is we can't guarantee that a trader's not going to go haywire. Okay, we've all seen it before. A trader is super, super stable. Think of a trader like martingale, right? Super, super stable, and then they can lose everything in one day. We have to protect investors and our own business and also the trader. So by risk adjusting every trader, we know that not only are we giving an investor an asset class that they can invest into that meets their expectations, but also that provides us, the trader and the investor, with longevity. Now, this is the dashboard on Darwinex Zero if you haven't seen this before, but I'm presuming the majority of you have. Automatically, it shows your Darwin return and your Darwin performance. If you want to see your Signal account statistics, you can just click the tab that says Signal account, but you can see on this example, it's grayed out. And that is because we don't ever show your Signal account statistics unless you opt in to do so. But I believe you can only do that on Darwinex. I don't believe you can do it on Darwinex Zero, but I could stand corrected. If anybody knows, please correct me, but I'm 100% sure, or 100%, 90% sure that you can't on Darwinex Zero. But you can switch between the two tabs. But as I say, I would never be able to view your Signal account statistics and you would never be able to view mine. And thus we would never know just how much you're being risk adjusted. So when an investor comes to you, what we don't want them to see is this person's operating at a really high level of risk at their Signal account level, so I'm going to avoid investing with those. Or this person's not taking too much risk on their Signal account level, so they're never going to make me a return. Because realistically, the return and drawdown you have on your Signal account level is kind of irrelevant to the actual Darwin, which is the actual investment asset. There's, of course, going to be a correlation, like the better return you make on your MetaTrader, the better return your Darwin is going to make. The lower the drawdown, generally, the lower the drawdown you will see on your Darwin, because it is taking exactly the same trades. When your Signal account is in a trade, your Darwin will also be in that trade. Simple as that. The only thing that we ever adjust is the risk. Now, understanding your value at risk, we give you a chart that updates in real time. It's a fully organic chart that measures your value at risk over, I say a period of time, but over the whole period of time. So you can see in this example, what we've done is we've stuck a fat white line on at the 6.5% level, just so that you can understand where this trader is. Now, at the beginning of this chart, you can see the trader is roughly 2x of 6.5%. So we can comfortably say they're probably operating within a 13% value at risk in this example. Now, because they're 2x of the 6.5%, what is likely to be happening at this point is that the risk engine is basically taking half of their size. So if the trader's trading with a 10 lot on their MetaTrader account, what's likely happening is that the Darwin is taking around 5 lots. Might not be exact, as in it might not be a 0.5x multiplier exactly, but it'll be there or thereabout. Now, what I mean when I say it's organic is that this is like a living, breathing chart. Every decision that you make will update your value at risk. As this trader is coming down and slowly moving down to 6.5%, they're still going to be risk adjusted down. So the risk engine is still going to be tuning their risk down at Darwin level. However, as they come down and down and down, this works in tandem with your risk multiplier, which is the calculation from lot size on your Signal account to lot size on your Darwin. So 1x multiplier would mean 1 times 1 equals 1. A 0.5x multiplier would mean 10 lots times 0.5x, which would be 5 lots. Times 0.5? Is that right? My maths is awful. I'm not even going to pretend I know how to do quick maths, because I don't. As the trader comes down to 6.5%, their risk multiplier is pretty much going to be 1 for 1, which would mean that the risk engine it would still be adjusting their risk per trade, but it's not going to be as dramatic, and your results will mirror each other kind of closer than ever before, because every 10 lot that you take on your Signal account level, the Darwin might also be taking 10 lots, or 9.9 or 10.1, for example, but there's going to be less discrepancy. As the trader goes underneath 6.5%, what that means is they're actually not taking enough risk to match the S&P 500. So our risk engine is going to scale them up at that point. The further that they keep going, the more the risk engine is going to scale them. If they get down to 3.25%, then guess what? They're going to be scaled up 2x, roughly, which would mean if they're taking a 5 lot signal account level, generally their Darwin is going to be taking a 10 lot. I don't know what's happened there. Oh yeah, I clicked something on my keyboard. I apologize. But the main point of this is that it is organic and it does update over time. So if you are going to make a change to your trading behavior, i.e. change your position sizing, for example, do it gradually. If you realize that your value at risk is a little bit too high and you don't really want it that high, slowly bring it down. Don't just go from trading 10 lots to trading a 1 lot, because it's going to mess up your value at risk and it's going to take a while for your Darwin to update. The risk engine generally has a 45-day look back period. So it's looking back at, the past month and a half of your trading, and then compares it to a 6 months average. So to ensure that you're not being under or over leveraged. So we're taking 2 sample sizes, comparing the 2, seeing if they align. And that's how we calculate your value at risk. So like I say, you have time, just adjust it slowly. Again, something that's private to you on your own dashboard is the Darwin live trades, which comes up as a little pop-up on the left-hand side of the screen. Now, what this does is it shows you your Darwin risk multiplier, which is what I've been talking about. It shows you your closure rate, which is if the Darwin has closed a certain amount of the position. So this is highly likely to happen in martingale situations, which is why martingale trading doesn't work too well at Darwinex. The reason being, we're trying to stabilize risk. So we're trying to make your trading look as smooth as possible from a risk perspective, at least. Now, when you're martingaling and you keep adding risk, you're already going into drawdown and adding more risk to the position. Now, while martingales look great on face value, quite often they can blow up, okay? And so what the Darwin will do, or what the risk engine will do, is it will start to slowly close some of those positions out as your exposure grows, because it's working kind of in an opposite direction as a martingale system. A martingale is going into drawdown, adding more size. The risk engine's going, whoa, this is way more exposure than we usually take, and therefore our leverage is getting out of control. So what it does is it measures your deleverage per position, and when it goes outside of the norm of what you're used to, it can start to close a certain amount of the position. It's nothing to be scared of. It rarely happens, especially if you're a consistent trader. And I don't mean consistently profitable. I just mean your behavior is consistent and you do the same thing day in, day out. You don't really have anything to worry about. And even if it does close some of your position, it doesn't necessarily mean it's a bad thing. There's been Darwins in the past where the risk engine has turned a losing trader into a winning trader. Perfect example is somebody who I always cover. So the guys who've been to these sessions multiple times will know I talk about a Darwin BLM, who'd been trading for 7 or 7.5 years through Darwinex Classic, had been a losing trader. So they'd made a couple of 100% return. Then they went 70% drawdown, back up, back down. And then after 7.5 years, they'd made 4% return on their initial investment into that account. So realistically, could that trader trade? I mean, short term, yes. Long term, no. However, their Darwin had produced a roughly an 11% return year on year. Super stable. Maybe not super stable, but a lot more stable than their MetaTrader account, which had made 4%. So all I'm saying is don't be scared of the risk engine getting involved, closing a certain amount of your exposure. Again, it's all done mathematically. It's not looking at you and going, oh, this guy's in a trade, let's close a little bit out so that he doesn't make as much profit, or, oh, this guy doesn't know what he's doing, so let's close some of his position. It's nothing like that. We're measuring your exposure, your deleverage, and then scoring you based on that. If you want to know more about deleverage and what it means, what it is, how it works, we do have a knowledge base where we break every concept down, or we also have some short form clips in our Discord, Instagram, Twitter, YouTube, everywhere. Where I cover them in like a 30-second breakdown. I would recommend everybody go and watch them if you're not 100% sure on what these concepts are and what these ideas are, just to make sure that you understand everything that I'm talking about right now. However, on with the presentation. Underneath this, it shows any trades that you're currently in. So you can see on this specific example, there is a Kiwi yen short and the trader is in 1.2 lots on their MetaTrader account. But because they're being scaled up by 2.32 risk multiplier, their Darwin is in 2.79 lots. Now, what going back to my point about making sure that it's a level playing field, what we're doing with that is ensuring fairness and consistency across every single trader on our platform. So if we think about two different traders, might be taking the same trades, okay? They might both be taking a euro dollar position on the long side, for the exact same reason. But we have trader A who trades with too much exposure, so their lot size is too high, okay? And we have trader B who takes the same position, but their lot size is too small. They don't take enough exposure. What the risk engine is going to do is likely scale trader A down and likely scale trader B up so that they meet in the middle at the standard risk level that we provide at 6.5% value at risk for your Darwin. Which will basically mean, I think this goes a little bit further as well, is it levels the playing field between every single trader. But what it also does is it levels the playing field for an investor where you go, the standard for investing realistically, or the globally accepted standard for investing is the S&P 500's return. It's accessible for everybody, professional investors, retail investors. That's what they expect. If you cannot perform or outperform the S&P 500 year on year, you may as well stop trading and just invest in the S&P, right? It doesn't make sense to risk your own money trying to outperform an asset that does it with less stress over a longer time period. It just doesn't make sense. So not only are we saying peer-to-peer, you're going to be operating with the same risk. Now, show us who's the better trader, but it also eliminates anybody underperforming the S&P, because if you are, you may as well just invest in the S&P. Your strategy will be as stable as the S&P. Now show us that you can provide a greater return. Sounds tough, but there's a lot of traders that do it. Now, your strategy's value at risk depends mainly on 4 factors, and I always categorize these into 2 different categories. The strategy-specific metrics here, and then there's a position size and perspective, and they work slightly differently, or at least in my head, they work slightly differently. So we have number 1, which is asset volatility. Of course, kind of common sense, the higher the volatility of the asset that you're trading, the higher your risk exposure is as a trader. There's more exposure to volatile swings, things going wrong, liquidity issues. For example, if you're trading Bitcoin as opposed to euro dollar, generally Bitcoin moves a little bit more violent. Generally, there's less liquidity, and so on and so forth. I could give you so many reasons as to why euro dollar is more stable as an asset, and therefore your risk exposure will be slightly lower. Number 2 is trade frequency. Again, it's kind of common sense. The more exposure you take in terms of how many trades you're taking, generally, the higher the risk that you are going to be operating at. It's not saying that everybody who trades frequently is too high of a risk. It's just saying if you have a trader who trades a lot per day compared to somebody who might trade once per week, if you're looking at trade frequency, trade A's higher risk because they are taking more exposure to the market. Again, there's more, even though there's more room for upside, there's also more room for downside, and therefore you have a higher value at risk. Not to say you're a worse trader or a better trader by any means. Again, this is all just a measure of risk. I don't like the word risk. It's all just a measure of exposure. Number 3, we have trade duration. Again, kind of a common sense one. The longer you hold a trade, the higher your exposure is. If I'm holding a trade for 10 days instead of 1 hour, I have more market exposure. Again, there's more room for error. There's more room for me to make stupid decisions. There's more room for black swan events or market gaps, whatever it may be. Therefore, my exposure is higher the longer I'm in the market. These are the 3 strategy-specific ones, going back to the categories that I was talking about. I don't always think that you should be, if you wanted to change or adjust your value at risk, if you're looking to slightly lower it over time, I don't think you should be looking at these 3, because that means having to change your approach to the market. And I'm not advocating that for anybody. Of course, if you've got statistical measurements that say, I need to adjust this, I need to trade an asset that's lower in volatility, or I need to reduce my trade frequency, of course, go ahead. But if it's to affect your value at risk, don't start changing your strategy until you've got your position sizing on lock, which is number 4, your trade size. The reason why I categorize this separately is because you could have a trader who trades euro dollar, so a really low volatility asset generally. You could take 1 trade a month and you could be in that trade for 10 minutes. Okay, so the guy basically takes no market exposure. Super, super low risk from an exposure perspective. But every time they click that button, they click the button with 1,000 lots. All of a sudden, the other 3 kind of fade to black. He's taking too much risk just because of his position sizing, or her. And so it's kind of in its own category, I think, because you can do all the same stuff here on the left-hand side, same asset, same frequency, same duration, but just by slightly lowering your risk exposure from a position sizing perspective means you don't actually have to change anything that you do in your strategy. However, your value at risk will come down, and therefore your risk multiplier will increase, and vice versa. If you wanted to increase your value at risk, your risk multiplier would, of course, come down. So I categorize them like that. Always attack the position sizing first before you start adjusting your strategy. Now, before we bring the session to a close, I'll just go over some frequently asked questions that we usually get. It's number one, when will my Darwin be listed? So we always create Darwins over the weekend. We do it when the market's closed, so that at least trades aren't running at that time. Now, what we do is, if you was to finish your calibration phase on the Friday, your Darwin would be created on the Monday. If you created it on the past the calibration on the Monday, i.e. hitting your minimum trading days and trading decisions, you would be created on the following Monday, okay? Doesn't mean that your trading history won't count. You just keep trading that account like normal. Which again answers question number two. Shall I stop trading whilst it's being listed? I always say never stop trading your account. I understand why some people do when they've, achieved gold status before the end of the month, or they might have a good allocation and they don't want to risk it. But I always just say, just have faith in your system. Never stop trading it. It doesn't get affected from our end, i.e. when your Darwin's being created, we don't stop tracking your trade. So every trade you take will count towards your Darwin and towards your return and drawdown. Number three, shall I increase or reduce my risk? I often say no to this, like don't pay too much attention to it. However, if your value at risk is above 30, what we've seen over the past 13 years of having Darwinex alive, if you will, is as soon as a trader passes 30% value at risk, the likelihood of them blowing up or having a really, really high drawdown exponentially increases past 30%. So I always say, again, it doesn't mean you're a better or worse trader, but I always say if you're above 30% value at risk, it might be worthwhile investing some time and energy into trying to bring that down. Again, it's not rocket science. You have the two different categories that you can approach it from: the strategy specific asset, duration and frequency, or the position sizing category. I always say go for the position sizing. If you're above 30%, generally it's not because of the strategy. It's usually because of the position sizing. That's the only case I would say you should think about reducing your risk. Number four, how to increase my risk multiplier. Again, as I've already mentioned, it works in tandem, or in inverse correlation, I should say, with your value at risk. So if your value at risk increases, your risk multiplier will decrease, and vice versa. If your value at risk decreases, I can't remember which one I said the first time around. I think I said if your value at risk increases, your risk multiplier will decrease, and if it decreases, it will increase. Number five, is it bad to have a high or low multiplier? Kind of goes in tandem with having a high or low value at risk. If your value at risk is below 30%, I wouldn't worry too much about it. Again, some people like to fiddle about with this thing, but the way I advocate for this is don't put all your focus on adjusting your value at risk and trying to get the perfect multiplier, because you're kind of just wasting your time. Focus on taking the best trades. That's the only thing that's in your control, is when and where you hit that button. I think you can get caught chasing your tail trying to get a one-to-one risk multiplier, which isn't going to serve you anyway, because no matter what you do at signal account level, it's always going to be risk adjusted at Darwin level. I can see a question from VJ on YouTube. I appreciate you putting a question in the chat. Regarding value at risk, what if the position size is high but the stop loss is tight? Therefore, the risk, let's say 1% of the account is low. It seems like the risk engine will still treat it as high risk. Yeah, so the risk engine doesn't even consider your stop loss or your targets. I mean, how tight are we talking? Are we talking 2 pips, 3 pips, or 10 pips, 15 pips? Because, it's all relative. Again, it's a whole bunch of different things. It's asset volatility, how often you trade it, how long you hold those trades for, and then your position sizing. Of course, the tighter your stop is, the higher the position size is going to be. So that will increase your value at risk. Like just as kind of general rule, it will increase your value at risk. The only issue I would say with a tight stop loss is what we can see from thousands of Darwins is the tighter the stop loss, the lower the capacity is for that trader, which means the less they'll be able to scale up into the hundreds of thousands / millions of AUM. Okay, so I don't know if I've answered your question there. I hope I have. It doesn't necessarily mean it will treat it as high risk, but it will be higher risk. Okay, so if you took the same trade with a 30 pip stop and a 5 pip stop, but it's the same trading idea. Obviously, the only differential there would be the position sizing. So the trade with higher position sizing, of course, would be higher value at risk. Yeah. Yes, you have. Thanks. Awesome, VJ. I appreciate the question. FX Pit Finder, great presentation so far, Kieran. You've not lost your fluidity yet. I appreciate appreciate that. I feel like this is a natural thing to me now. I do these sessions 3 times a week. I love coming on and speaking to you guys. Pit Finder, it's been a while since we've had a conversation, so it's great to see you back here. And I've not lost my fluidity yet. I have my days. It's been hot over here in the UK recently, so on the hot days, I generally struggle to focus and get my words out. And by the time I always run these sessions, it's late afternoon as well, so I'm always tired. I'm an early bird. I start working at like 6 or 7 in the morning. Just power through. So by this time of day, yeah, I get tired. So it's great to think it's great to see that you don't think I've lost my fluidity, because sometimes I sit here thinking I have. So right, just to round up the session. Oh, I can see a question from Lance Kansana as well. Does Darwin still continue to adapt after the calibration phase? Yes, it 100% does. So if you was in the session when we had the value at risk chart on this one, this is an organic chart that will update for the whole lifetime. So it's operating 24/7, whether you're in a trade or not. It's constantly adjusting to your new behavior. So if you're with us for 5 years, of course, you're going to have growth and changes over that 5-year period. As I mentioned, the risk engine has a 45-day look back period. So it's looking at your most recent trading behavior and then comparing it to a 6-month average, kind of taking in sample and out sample data, comparing them against the two, and then ensuring that you're not being under or over leveraged at any given point compared to your history. But if you're making changes, of course, your value at risk chart will adjust over time, which is why I say do it gradually so that you don't send a shockwave through the system. The worst thing that could happen, right, is that you have, let's say, I'm trying to figure out in my head which way around it is. I'm going to say anyway, you have a high or low value at risk, and then all of a sudden you drop your risk. Okay, so you have a high value at risk, and then let's say you go, my value at risk is too high, so I'm going to drop from trading 100 lots down to a 1 lot. You then drop down to a 1 lot for that position. It turns out to be the biggest win of your career, but because your value at risk was so high, it copied it across at such small size that you might make, pennies in profit, although it was the best trade of your career. So it's always best to do it gradually and do it slowly over a period of time so that there's no drop off in performance, or where the risk engine needs to kind of recalibrate your behavior. Just kind of see, I always say to people, give it 3 months, just give it a 3-month period where you gradually change your behavior. Set yourself a task. Okay, by this time next quarter, I want my value at risk to reduce from 45%, let's say, down to 20%. Seems like a big gap, but let's say you go, on average, I take 5 positions per day. I'm going to start at 10 lots on that position. The next day, I might take a 9.8 lot. The next day, I might take a 9.8 lot. Next day, I might take a 9.6, and you're slowly bringing it down over time. That way, the risk engine's not going to have a hissy fit and go, well, this guy was, taking all of this risk last week, and then now all of a sudden, out of nowhere, he's barely taking any risk. It's completely different. It's going to take me a while to kind of recalibrate this. 45 days, because we're taking an average over that period of time. So again, hope I've answered your question. In short version, yes, it does continue to adapt. Long version was everything that I just said. So yeah, I just want to say, well, before we bring this session to an end, I love communicating with all of you. I love these sessions. I love having conversations with you all. You know, and I enjoy getting to know how you guys feel about Darwinex, things that we can improve on, and you know, everything in between. So if you want to talk to me or talk to the community on a more frequent basis, I highly recommend joining the Discord. We've got over 10,000 members in the Discord server now. I'm in there 24/7 pretty much, apart from when I'm sleeping. You know, we've got some really great guys and girls in there who are basically like your first lines of support. So if you have a question, jump in the Discord, ask us. If I'm not around, we have some great people in there who will help you, and usually get your questions answered quicker than going on Google and doing a Google search, or, you know, emailing our support team. So I highly recommend, if you're not in the Discord, to come and check it out. We also have a partner program, so we're always looking for new partners to work with us. You obviously have to have the same values and ethics and morals that we do as a company. So we're not partnering with any Lambo people, you know, who are selling a dream to everybody. But if you have a platform, if you have a community, or if you just want to partner with us, I'm always happy to have a conversation and see what we can work out, and if we can work together in a mutually beneficial relationship. So if that's you, please drop us a message on any social media platforms that we're in, or if you're in the Discord, shoot me a direct message. My DMs are always open. Sometimes takes me a while to respond to them because they get flooded on a daily basis, but I will get round to coming back to you. And you know, we can always jump on a call at any given time. And lastly, we have a member get member scheme. So if you're trading with us, everybody has a member get member code, which basically means if you bring your friends and family to Darwinex Zero, we will reward you with a 3-month subscription. So all you do is refer a friend. Once they've paid for their subscription twice, we then credit your account with a 3-month subscription, and that is available to everybody on the platform without having to speak to me or the team. Lastly, I just want to say a thank you to everybody for attending these sessions. Without them, it'd just be me speaking to a camera, and that's pretty boring, right? And pretty sad, to be honest. So I just want to say thank you, everybody, for joining. Thank you, everybody, for sending in your questions. FX Pick Finder, it's been great to see you again, dude, or at least speak to you again. Again, I'm just somebody looking at a camera and speaking to nobody. But it's been great to have you in the session and to have a chat with you again. I can see Theo Wealth is typing a message in the Discord. So I'll wait for them to finish typing before we call it a session. I'll try to be here as often as I can to support you. Legend. Appreciate that. Appreciate that. And just hang about in the Discord as well. Like, we can always chat in the Discord. My goal, I mean, been pretty busy recently with product development side of things and trying new things for kind of the business. But one of the things that I would like to implement over the coming months is kind of a Darwinex TV, where these streams become longer, more relaxed, you know, more inclusive about topics like just looking at charts, data, you know, news events, all that sort of stuff, and then we do the presentations in between. So let me know if you think that would be beneficial, because I'd much prefer to do something like that, where I'm streaming for a couple of hours, we do a presentation, then we all hang out and, you know, watch a charts, watch a news drop, and all that sort of stuff. Theo Wealth said, can you list all the Darwin staff members, admin, and support team? There are too many scammers that try to request to be a friend with us. Yeah, okay, so that's a great point. So this is in the Discord, by the way. So if you are in the Discord, any Darwin staff member or admin or support team will have an orange tick next to their name. Okay, so anybody who doesn't have within the server, who doesn't have an orange tick next to their name, that's a fake, it's an impersonator. I can only ban them as they pop up, so I can't preemptively stop somebody from sending a friends request or a message request, unfortunately. I wish I could. I get a lot of fake people, so I kind of check every day or every couple of days and boot out any fake accounts, but they're like a virus. They keep coming back. If somebody does send you a friend request, 9 times out of 10, it is going to be a scammer. We kind of have a policy where we don't actively direct message clients first, or members of the Discord first, and we definitely don't send friend requests unless we've explicitly said so in the chat. So if I message you in the English chat in the server saying I'm about to send you a direct message, it is me, then of course you can then check my username, ensure that it's me from the server. You know it's me from the server because I've got an orange tick, and then you can chat to me. If those checks don't work out, then yeah, don't speak to them. I've actually had somebody before, really sad situation, probably about a year ago now. Somebody had impersonated me and managed to get somebody to invest into I think they invested $1,000 into a copy trading scheme that was on a website. I mean, realistically, if they'd have done their due diligence, they'd have probably found that it was a scam. But yeah, so it is something that hold dear to my heart because I know people who have been affected by that with my face and my name on the situation. So great point there. Well, I just always say, just do your due diligence. If somebody's adding you as a friend, make sure it's actually me or one of the other guys, because we would never just add you and start talking to you, and especially talking to you about how's the market been for you recently. I have a revolutionary trading bot or copy trading. Of course, that's likely to be a scam. Okay, then, guys, that looks like that's all the questions. So once again, I appreciate you all for attending the session. Sessions are nothing without you. I will be back on Tuesday to do a welcome session. I might throw in a couple more sessions next week. Let me see what time I have and see if we can be a bit more fluid with them. But if I don't speak to you before the end of the week, have a fantastic weekend. Don't forget, tomorrow is July 4th, so the US market is closed. So don't go in thinking that the Nasdaq's going to rally 500 points, because it's probably not going to happen due to it being a bank holiday. But with that said, I'm going to close the session now. Have a fantastic rest of your week and a great weekend, and I'll catch you in the next session.